everyone. Um, Thank you all for coming. I'm David Samra, and I manage the International Value Fund at Artisan Partners. And as an alumni of the business school and a practicing value investor, I'm really thrilled to host this event because this is a great way for the business school and the students to exhibit the quality of their work. But I think more importantly for them, it's another step in the preparation and in the process of developing students into the investors of the future, which I think we sorely need, more value investors.
More competition, great.
So there's a lot of history actually surrounding this event, and Paul Johnson is going to take us through that. But before we kick it off, I want to thank the Halburn Center, and I, in particular, want to thank Meredith Trivedi, who has had steadfast support and has often needed steadfast support of keeping this stock palette pitch challenge up and running. And also, I would also like to just briefly introduce our judges. They are all very busy people, and their time is valuable, and they volunteer, some traveling from very far away to participate in this event. So I'm just going to mention their names, and if you feel like raising your hands to identify yourself, that would be great. Jenny Wallace from Summit Street Capital, Lauren Kruger from KKR, Paul Sonkin, author and adjunct professor at CBS, James Pan, CP&E Partners, Jason Leader, where's Jason, from Leader Fiduciary Capital, Carl Kawaja, who came in from California, Capital Research and Management, Dan Kruger, who is actually related to Lauren Kruger, from Owl Creek, Jeff Hume, who got me involved in this many years ago, is now at Gerber LLC. And today, I'm happy to announce that we have a superstar guest judge, Tom Gaynor, who is the CEO of Markel Corp. And Tom has graciously agreed to come up and speak for a few minutes. I mentioned Carl, yeah. And so Tom's going to come up, talk for a few minutes, and then hand it over to Paul Johnson, who will take us through and give us all some context, and then we'll kick off the challenge.
Thank you.
Well, thank you. Thank you so much for having me. I'll just say a couple of things and look forward to tomorrow's panel as well. But first off, I do deeply appreciate the invitation. David, you gave me some tough news. You said, I just had volunteered to be here. I thought we were getting paid. The essence of being a value investor.
Did you get some water?
I didn't, but that's okay. Yes, I got the water. Thank you. I didn't know that was the speaking fee. But as an investor, to be invited to something at the Columbia Business School, that's a big deal. And this is where Warren Buffett studied investing. And clearly he's been my hero in investing. James and I have known one another through Omaha connections for over 30 years. And that is where we met and convene and gather every year. So just to be here in and of itself is a special thing. I'm very grateful for the invitation. I did participate in something here. It was a different thing, but it was a speaker thing. I'm guessing it was 12 or 15 years ago. I have forgotten exactly when it was and what it was. And I guess that's why I got invited back. Because anybody who was there at the time said, oh, we're never inviting him again. But 12 or 15 years have passed and the cast of characters have changed. So I got an invitation, and if Columbia invites me, I am saying yes. So point number one. Point number two, I want to thank Columbia also for teaching my colleague, Tyler Brown, who's a graduate of this program. Now, undergrad, he's like me from UVA in Oahu. But he came up here for his MBA. Tyler joined me in January of last year, and he's been a fantastic partner. He is the essence of someone who has a liberal education, and I think Robert Hagstrom wrote a book recently, talked about investing as the last liberal art. And I think there's so much to that concept. And I appreciate Tyler's partnership because he truly has the table stakes of the quantitative side of investing, but he thinks in a liberal arts mindset as well. And I'm really grateful for Tyler's partnership. And this is your school, so it was Tyler who said, hey, Tom, will you do this? And because you're a Columbia alum, said, will you do this? I said, yes. So I'm very glad to be here. In addition to all those factors, again, the industry needs a wellspring of talent for the future, and the idea of value investing and being grounded in something as opposed to floating in free air. If you go back to, again, Ben Graham is the spiritual father of all of this. He was a classicist and studied all the disciplines that one would think of as a liberal education, but he also brought some discipline and some STEM-type aspects to join up with his liberal education to have some discipline in some sense of how to be a responsible steward of investment. So I'm just glad to be here. Look forward to the conversation tomorrow. And with that, I'll turn it over to you, Paul. Thank you.
Thank you, Tom.
All right, see if I got this set up correctly. All right,
Welcome, everybody. This is my favorite event of the year. I'll explain why momentarily. But every year, one of the many events that Halbrand Center sponsors is the Graham and Dodd Breakfast. And they bring a world-class speaker to come and talk to not just students and alumni, but a lot of people in the industry. And it's always a great event. In 2013, I attended the event. After the event, I ran into Paul Sonkin loitering around. And I had known Paul for about almost 20 years at that point. He was a student of mine in the fall of '94. For those of you doing your mental math, I started teaching when I was 7 years old. And he convinced me, one of the few things that it's ever happened, he convinced me to teach a second course in the spring of '95, which he also took. He then graduated in May of '95. He was my TA for a couple of years. And then in 1997, we team taught the value investing seminar course in the full-time program when Bruce Greenwald was on sabbatical. That was a lot of fun. Buffett came to speak and some other great speakers. We had a lot of fun doing that. And then in 1998, Paul launched a new class, developed a new class and launched a new class called Advanced Value Investing AVI. And this year was the 25th anniversary of that launch of that program. The ideas tonight come from the AVI program. So this is one of many of the connections that this event has brought together, which I love. Lots of fun. I hadn't seen Paul, at that time I hadn't seen Paul in a couple of years, so I just, as you do to people you know, I said, what's up? And he informed me he was writing a book. And I laughed and I said, good for you, because writing a book will kill you. Good luck with it. I said, but by the way, what's the title of your book? And he said, The Perfect Pitch. And I laughed. And he said, why are you laughing? And I said, well, if I were to write a book, I was going to write a book called The Perfect Investment. And true, absolutely true. And so we started talking about the various books, and we realized we were going to write the same book. And I thought, all right, so this was Friday morning. By Sunday, he convinced me to write the book with him. That's how persuasive he is, which was a lot of fun. In that first meeting, he said to me, because he said the perfect pitch, I said, why do you care the pitch? I mean, who cares? The analysis is where it was. And he said something which I'll always remember. He said, the pitch is the architecture of the research. And I'm like, what the fuck did you say? And I had been an analyst for 20 years. And the way we did work is you do the work. I've done dozens and dozens of pitch. You do the work. At the end, you figured out the pitch. And Paul said, no, you have it backwards. You got to work backwards from the pitch to do the research. I was like, you're nuts. But I decided to write the book for him. It took me a year to realize that genius. And so we worked together on a book, and 4 years later, we published the book. I'll Pitch the Perfect, which we're giving, you did get a present. Thank you. All right, man. And lots of fun. In January of 2017, Paul called me up early January, and he said, how would you like to be a judge at a stock pitch competition? And I thought, well, that would be great because we could try out these ideas and see how they go. And the bonus was it was at Columbia, so we didn't have to travel to some other school. I said, great. I'd only been teaching there 20 years. I had no idea there was a stock writer book on pitching. And I said, when is it? He said, end of January. So it was a Friday night, bitter cold Friday. I think Saturday and colder. Remember Saturday, you stayed home? Colder. So I get up it's at Warren Hall, and I get there at 6:45 for a 7 o'clock event, and I'm waiting around, and I walk up to the reception, and the nice student there, I said, I'm Paul Johnson, I'm one of the judges tonight. And she said, I don't think so. And I said, why not? She said, because all the judges are having dinner together right now. And so I was like, okay, so I walk away, I called Paul, and I said, dude, what up? He said, look, I'm parked around the corner, but the meters don't stop till 7. He's a value investor. He said, so I'll be there in 10 minutes. So he comes around. I'm thinking, I'm going home. How do I get the subway and not die in the bitter cold? And he comes in, and Jeff Holm comes in, and James Penn. All come in at the same time. I'd never met Jeff before, so I met Jeff. And James, I had met a couple of times. He had taken one of my classes, not one of my courses, one of my classes back in '93. And so I wasn't a judge that night. I don't think you were a judge either, but we sat in the audience. It was really quite fun. I didn't sell any books. I don't think we sold any books. And certainly we didn't influence anybody. But I was introduced to a wonderful event and some amazing people. And this event has this history. So I want to talk to you a little bit about what I discovered on that cold night 6 years ago.
All right.
Just to confuse you, this is the 13th annual event. It's the 4th Artisan Value Pitch, but it's the 13th event. It's the 5th event sponsored by Dave Samra, so go figure that out. I'll explain all that. Past winners, last 5 winners, we have listed here.
And then I have all the winners in a minute.
As Tom said, this is a rich history. So Graham starts teaching in 1927, in the fall of 1927. He graduates from Columbia College in 1914. He's the salutatorian, number 2 in his class. He gets out in 3 years. And when he's about to graduate, he's offered a full-time teaching position in the math department, the philosophy department, and the literature department. So you talk about liberal arts. I'm sure some of you have friends that are that good in math, philosophy, and literature. He turns them all down because he wants to go to Wall Street. His family was basically broke. His father had lost all their money in the crash of 1906, the Knickerbocker crash. He lost all his money. He wanted to go to work. Oh, by the way, on the way out of school, the Columbia Law School offered him a 3-year scholarship free into the law school. Very talented. He went to Wall Street first as a bond salesman. He didn't like that, didn't do very well, and he naturally migrated to analytics. There was no research departments on Wall Street at the time, and he invented that. And he was quite good at that. In 1927, he decided to come back to Columbia, his alma mater, to start teaching a class, partially to organize his thoughts because he wanted to write a book. 7 years later, he writes a book with David Dodd, number 2, and that is the birth of value investing and the birth of fundamental investing. Pretty cool. He taught for 29 years as an adjunct professor. David Dodd was a young master's degree, getting his PhD here. And what Graham said was, I'll teach, but I need somebody to take notes. And that's where he was introduced to David Dodd. They went on to write this very important book. That goes on for a while. 1956, Graham decides to retire and move to California, to La Jolla. And Courtney Brown, who's the dean of the business school, had just gotten assigned to dean, wanted somebody to take over this course, a very important course. And he got this guy, Roger Murray, to come take over the course. And Paul and I just published this, the history of the biography of Roger Murray, very interesting. He taught for 21 years, and most important, he taught people like Mario Gabelli, Leon Cooperman, Art Sandberg, Chuck Royce, and a bunch of others. We have that history. He retired in 1977 and went away. I'm going to talk about him coming back. Bruce takes over the program in 93, 16 years later. He teaches for 18 years until
2018. So we have this very long history at Columbia, which is pretty cool. We talked a little bit about that. We talked about David, Roger, and then we talked about Bruce.
Bruce, in 1993, Mario Gabelli decided that it would make sense to have Roger Murray come and do a series of lectures, which he did at the university, at the Museum of Television and Radio, now called the Paley Center. And he came up 4 Fridays in a row in 1993 and spoke for 90 minutes each time without a note, standing up. He was 88 years old at the time. Pretty impressive. I found out through this event that Jason, James, and David were at those lectures. And I didn't find that out until we were writing this book, and I happened to mention that to David. He said, no, we were at those lectures. I was like, wow, that's really cool. Bruce, this is the great quote that Bruce said. He attended the lecture. There was no value investing program at the time. It had died out in '77.
And he said, like generation investors who preceded me, I was struck by the compelling logic of Graham's approach, which is what Murray taught. As a consequence of those lectures in '93, I dragooned Roger Murray into joining me to offering a revised version of the value course in the fall of '93. And this was the course. It was called The Fundamentals of Investing Approaches to Value, an advanced seminar co-taught by Bruce Greenwald and Roger Murray. They taught the first 5 lectures, and in the next 7 lectures, they had guest speakers. Buffett King, Gabelli, Chuck Royce, Seth Klarman, Michael Price, passed away last year, Bob Roos, Walter Schloss, and Andy Weiss. I mean, just an all-star group. And that, I think, is now called the Legends course, maybe, many years later. And it's the same thing, which is pretty cool. And then the final project was discovered unloved or undervalued stock. And the program took off. All right, so here's the history of the Halbrand Center, which is another part of this. In '84, famous essay by Buffett, The Super Investors of Graham and Doddsville. In '84, Barbara Lerner, who's David Dodd's daughter, donated some money to start this whole thing. Pardon? Anderson, right. Oh, it's Barbara Lerner Anderson?
No, it's Barbara Dodd Anderson and then Helene Lerner.
Ah, I got the 2 names. Thank you. Great, great. In '97, they launched the investing conference, which is tomorrow. In '02, the center is established with Halbrand's money. Robert Halbrand, father, was a personal friend of Graham and talked very highly of Graham. And when he passed away after the crash, Robert Halbrand inherited a bunch of money. And his father said, if you ever need investment advice, call this guy Ben Graham. And they became lifelong partners. And so Halbrand very closely tied with Ben Graham. In '04, they launched the Value Investing Program, which is what these students are taking now. In '06, they launched the Graham and Doddsville, which is they publish twice a year or 3 times a year? Twice a year. The students publish a newsletter. It's really quite good. In '08, they launched the Pershing Square Challenge. This is the one this is what we're taking on to match Dave. We're going to match over time. There's some inside.
You're getting much better.
Yeah, we're getting there. In '10, they launched the from Graham to Buffett and Beyond dinner in Omaha to play off of Bruce's book, which Paul Sonka was a co-author of. See how well it's great. And then in 2020, the Artisan, they took over the Artisan Challenge. All right, a couple more things. What this is, it's the best recommendations from the AVI program, the Advanced Value Investing Program. 9 were submitted. Last year we had 9. We had 9 this year too, right? How do we go from 4 classes? All right.
Said he submitted 3.
Is that what it is? Yeah, all right. Dave Samra, Artisan, we talked about that. It's in honor of Alex Porter, Nietzsche Capital, and Moon Lee. I'm going to talk about that in a minute. And then the winner is technically awarded the Sonkin Prize. All right, so here's the full history. So it was the Moon Lee Prize for 5 years. It was the Nietzsche Capital for 2 years. It was the SEMA Conference for 2 years. And now it's the 4th Halbrand-sponsored Artisan Partners. Lots of cool. Quick story about this, just so you know, Alex Porter was really one of the gentlemen. There was an article, he was the last gentleman on Wall Street, written by Kate Welling, who was a fairly famous Barron's writer. He had worked at A.W. Jones, which was the first hedge fund on Wall Street. And then he launched in '76 from 3 friends, Amici Capital, that's where he get his name from. He hired this young man named Moon Lee out of Harvard Business School, was a very passionate value investor, and died at a young age, apparently a gem of a guy. And in honor of that, Alex Porter came to Columbia and said, I want to do a stock pitching contest in his honor, which he sponsored, and that was the first 5 years. Unfortunately, Alex passed away in 2014, so they changed the name from the Moon Lee Prize to the Amici Capital Prize in 2015. Now, there was no 2016. And then in 2017, Jeff Holm, that's the one I attended, single-handedly resurrected, and he wrote the check to get this going. The next year, we got a bunch of students involved, and that took some of the administration away. And then in 2018, Jeff, through James, convinced David to come and sponsor it, and that's when he wrote his first check. And you'll see that the generosity and the connections of all this is what makes this thing so valuable. Jeff had worked for Alex Porter while he grew his fund from 75 million to over $2 billion. I told you he single-handedly kept this thing alive in 17, all in honor of both Alex and Moon Lee, which is pretty cool. We talked a little bit about Sonkin. He taught here for 17 years. He funded the Sonkin Prize with a donation to CBS a long time ago. And originally that was awarded to the best paper and Bruce Greenwald's course. Then Dave Sammer, we've talked about, he and James and Jason attended the 93 lectures, and they were very frustrated that there was no fundamental investing taught at Columbia Business School. At that point, they only taught market efficiency, beta, and things like that. So at the break, they approached Gabelli and Greenwald and the dean and were haranguing them why there wasn't value investing here at Columbia. A lot of things were going on behind the scenes, and that all came together. And as you saw in the fall of 93, the course got relaunched. So without their involvement in 93 and a few other things, we wouldn't be here tonight. I didn't discover that until fairly recently, which was kind of fun. James Penn also graduated in 93, and he did the same thing. He has a great background. He's worked for some of the greatest investors on Wall Street, and he went out on his own in 1998. So you're good, you get to do that. We talked a little bit about this. David was head of the investment club, and they would have pitch competitions funded by Mario Gabelli, right? So recycle this. And he would have guest speakers like Mario Gabelli, Liz Bramwell, Lan Cooperman, and Chuck Royce, which really became the architecture of the value investing program that I really love. We talked a little bit about the Murray lectures and their importance in all this. All right, back to the book for a second. So Paul and I decided we'd write a book for MBA students and interested undergrads, but really for students on how to pitch a stock. Remember, he said to me, the pitch is the architecture of the research. And so we decided to write this book together. We finally, 4 years later, we published the book. A couple of things to take away. Number one, keep the slides simple for a couple of reasons. Number one is your audience can either read the slides or listen to you. And the natural temptation is to read the slides. So the more complicated the slides are, the more they're going to take their attention off of you, read the slides, and not hear a thing you say. So that's probably a good idea. The second, equally as important, is there is a huge difference in the investment world knowing the difference between the key issues to the stock and just doing a lot of work. And it's easy to put up all the slides and say to the portfolio manager, you figure it out. I've done all this work. You're more experienced. You figure it out. And they're not going to figure it out. So you've got to keep it simple because they don't have the patience, they don't have the interest. They're looking for a reason to move on with their life. They don't really want to hear your pitch. You've got to make it compelling. You've got to keep it simple. And you want them focused on what you're going to pitch. The second thing is you want to address the portfolio manager's objective and subjective criteria, which in a stock pitch competition is impossible. There's too many judges, and they all have different criteria. So you're never going to do that one, skip that one. And then finally, you want to answer 4 key questions that every portfolio manager is going to have when you pitch a stock. Number 1 is, how much money can I make? That's the upside. And most students do a pretty good job on that. In fact, I would argue too good of a job on that because they spend all their time. Number 2 is how much money could I lose? That's the downside or risk. Number 3 is why is the stock mispriced? Because if the stock's not mispriced, maybe your recommendation isn't so good. That becomes key. And then the last one is catalyst. What is going to cause other investors to wake up and realize it's mispriced? Might just be time, by the way, but that's your catalyst. So we had a lot of fun with it. This is the only question that matters. Why is the stock mispriced? Because if you can't answer the question why the stock's mispriced, maybe it's not mispriced. And if it's not mispriced, why is it such a good investment? And as Paul likes to say, at that point he always says, why me, oh Lord? Meaning, why am I so fortunate that I've come upon this idea? All the investors, highly motivated, very educated, incentivized, but you're the one that figured it out. Particularly, you've only done the idea for a couple of months. All right, so we'll see how everyone does against this criteria. All right, last year's winner was long KKR. Was 61 on the day of the challenge. Target price of 136, 58.62 today, down 3.9%, but he did outperform. And there's the stock chart. All right, that's it. We're going to now see 4 fantastic pitches. All right, thank you.
10 minutes for Q&A. Whenever you're ready.
Hi, everyone. Thanks so much for taking the time, especially on a Thursday evening. I'm delighted to be here. I have an exciting long investment recommendation for Autodesk. The ticker is ADSK. Autodesk is a global leader in 3D make and design software. The company creates products that cater to customers in architecture, engineering, construction, manufacturing, and media. Here we can see the stock evolution over time. So the phase one for the stock is the legacy business model. This is the licensing business. Phase two is a transition from the licensing business model to a SaaS subscription-based model. And phase three is the current period. Since 2018, the stock is up only 40%, while revenue has doubled from $2.5 billion to $5 billion. Operating margins increased from negative territory in 2018 to 20%. Revenue has been growing at mid-double digits and has been growing through the pandemic. The stock has derated 35%. That provides an opportunity to buy into an attractive long-term competitor that's also an under-earner. There's 4 pillars to the long thesis. 1, attractive growth algorithm. 2, pricing power. 3, margin expansion. 4, a driven management team. For the research process, I did 21 different bar conversations where I talked to former employees, executives, and customers to try to better understand the customer value proposition and customer behavior. I see 80% upside for the long investment recommendation through the end of calendar year 2024, which is end of fiscal year 2025. This is a bear bull debate. The bear thesis is essentially that there's a transition from the transition to the SaaS subscription model has already played out. AEC is potentially more exposed to a downturn. There's execution issues related to a transition to a cloud-based platform model, and there's room for even better management incentive structures. The rest of the thesis is about the bull and upside, so I'm going to skip right past that. Okay, here's the variant view versus street estimates. Essentially, it's a line-by-line assessment of comparing my numbers versus street. For FY26, I have 20% earnings upside versus consensus estimates. This is driven both from revenue side with pricing growth and customer growth, and also from the expense side, as I expect to see operating leverage helping the business. Value driver 1 is attractive growth out. The company is transitioning its solution strategy away from a siloed products offering into a cloud-based platform model. This platform transition essentially increases execution speed. It increases the ability to create more insightful data solutions. It increases data integration for customers. 13 of my VAR conversations talked about how a challenge is that Autodesk sells 100 plus products to customers. The platform model helps address this by helping address the customer challenge and integrating everything into one platform, into different platforms. So there's several slides with walls of text. I'm actually going to skip right through those. There's a large TAM. Currently, there is 6.4 million paying subscribers, and there's 15 million non-paying subscribers. Considering the paying and non-paying subscribers, that's a 35% TAM penetration. Of the 15 million non-paying subscribers, management identified 2 million as potentially converting over into paying subscribers. Of the 2 million that management highlights, I currently model in 800,000 conversions through FY26. On the right-hand side of this slide, we can see a revenue breakdown. I expect mid-double-digit revenue growth over the coming years. And I break this down into subs growth and pricing growth and try to understand the underlying drivers. Sell-side does not properly do this. I was able to get access to Goldman models and Bank of America models, and they actually just have revenue growth with a simple revenue growth estimate without trying to dissect underlying drivers. Here's I'm assessing Autodesk versus prior downturns. Autodesk has 93% of its revenue in subscription-related revenue, so it's more resilient versus prior downturns. Value driver 2 is pricing power. So just as how mission critical Bloomberg is to everyone in this room as investors, and how mission critical CoStar Suite is for real estate leasing agents, AutoCAD and Revit are mission critical for architects. 17 of my conversations talked about how there's high switching costs. High switching costs essentially come from the training involved to understand the complex products, the time required for the training, and the fact that Autodesk products are integrated within customer workflows. A customer can't wake up one day and suddenly decide to switch away from Autodesk. All these factors point toward pricing power. They point toward an ability to increase pricing because there's high switching costs. So there's an ability to increase pricing, and there's a willingness to increase pricing. The company increases prices by 3 to 5% on an annual basis. Value driver 3 is the margin expansion narrative. Essentially, with pricing power, that drops to the bottom line, that helps margins. There's economies of scale, there's a change in mix shift of what's happening, and they're selling higher quality products. And essentially, I mentioned earlier that operating margins were in the negative territory in 2018. They're at 20%. I expect margins to climb to 30% through FY26. This slide tries to compare Autodesk versus peers in the information services segment. The takeaway here is that Autodesk has higher growth and potential for higher margins. Value driver 4 is about how there's a driven management team. I tried to better understand the CEO, Andrew Anagnost. The conversations that I have describe the CEO as very impressive. He's amazing, he's capable, he knows how to think about strategy, and he's a good communicator. The CEO is capable, driven, and aligned. In this slide, I document each of my conversations, where for each of the contacts, I tried to ask them to assess the CEO across different dimensions. How are they on raw intelligence, analytical capability, creativity, ability to garner organizational support, etc. This tries to quantify the assessment of the CEO, the management team, and the culture. The CEO ranks highly in terms of raw intelligence, analytical capability, and efficiency. We're nearing the end here. So essentially, there's 80% upside for a long investment for Autodesk through end of calendar year 2024. This is using a 2-year forward EV/EBIT multiple. This is a long-term compounder where the stock has been CAGRing at 22%. There's high free cash flow conversion, high margins, high revenue growth, and there's a $5 billion buyback, so that's a 10% buyback. Mentioned earlier, 20% upside to earnings estimates. I want to leave everyone with a final story. This is the power of 10 parties. In the biography of Autodesk, the founder, John Walker, describes the power of 10 parties. When Autodesk initially made $1 million of sales, there was a celebration. In that celebration, the founder looked forward and was excited about a $10 million celebration. No, not everyone believed it. When they reached $10 million, there was another party. At $100 million, there was another one. On the horizon, I expect there's going to be another 10 million, power of 10 party in the near future. And I hope everyone here would be investors and ride the journey with Autodesk. Thank you very much. Appreciate any questions.
What's your seat growth in terms of the next 2 years?
Could you repeat that?
What's your seat growth or subscription growth? The number of subscriptions, how much is it going to grow?
So subs growth, I have about 9% on an annual basis. Where
So they're going to be 9% more seats?
Part of that is the 3.5% to 4% of that 9 is coming from the conversions of non-paying to paying. So those are people that already have the Autodesk platform that are shifting over to paying subs.
Why are they being able to use it without paying
So
that?
that's my question, is sort of like, can you talk about the dynamics with more than 2/3 of the users not paying, but somehow in a downturn deciding they're gonna pay? I would like to understand that.
There's several puts and takes there. So throughout the years, the company's been around for 40 years. But over the past decade, 2 decades, et cetera, it was easy to download a pirated version of the software. And college students also got their hands on the software without actually paying for it. And also this is an international organization where they have 35% of their revenues is US based. So there's a lot of the illegal downloads are in non-US regions as well. So part of the issue was that when they had the licensing based model, it was one-time product subscriptions and one-time product sales and customers get their hands on the software. But now it's the SaaS business model. So now they're able to better increase their security, they're able to protect their IP, and they're able to better track the amount of usage that customers have. So currently, they actually are able to identify a lot of these non-paying users. And every now and then they do get some type of notification encouraging them about the new qualities and facilities offered with the paying subscription. And they're gradually trying to ramp up their ability to interact with these users and get them to become paying subscribers.
Nitesh, just really quickly, I couldn't find your 4 billion of EBIT in your numbers. Can you, it's just a math question, can you show me where you get that?
4 billion EBIT is coming from the FY27 non-GAAP operating income, where I'm using
2
the
years
2-year for
forward from
EBIT.
25, but, okay, go ahead. So I look at 25, it doesn't look like you're even close to 4 billion.
So at the end of FY25, I'm using a multiple on FY27 numbers. So the FY27 number isn't on that screen, which is why you can't see it.
But what's EBIT in 25? Or
So
26?
GAAP operating income is 2.1, but non-GAAP operating income is 3.37.
Where's that number?
Towards the bottom, 3.3.
Oh, okay.
What's the subscription price per seat, like 80 grand?
Is that done?
Yeah, I was just looking for that number, thanks.
What's the subscription price per seat? 80 grand?
So there's several numbers for you. So if you go online and search AutoCAD, it's about $1,800 per year. If you search Revit, it's $2,600. If you search the AEC collection, which is a bundle of a handful of software, it's $3,600. However, their ASP on a weighted average basis is actually just $880.
$880.
What is that average of paying and non-paying?
It's the average of the current paying subscribers. And the reason there's an issue there is there's differences in terms of their distribution channel and also international customers. And that causes part of the issue. Plus also, like, they have lighter versions of the software, like AutoCAD Lite, Revit Lite, which are cheaper than some of the list prices that I just mentioned.
Can you talk about this difficult switching costs associated, if you have a pirated version and you're happily using it, will it continue to work? And I may have high switching costs, but I may not need to switch, so I don't have to buy the new one. Is that correct?
So one of the customers that I talked to has been using Autodesk for 20 years, and she has a license off, I think, from like 2011, where
Like a one-time buy?
she got it back then and she continues to use it. Where the issue there is she does not have access to the newer features of the software, and it's less integrated with the platform type model where it doesn't easily interact with the other products that Autodesk offers. However, for her role, she's comfortable with having the limited version and dealing with the notifications that she gets that, hey, potentially you wanna update your software.
So I'm still trying to understand like what the market is missing, like why it's mispriced. Because there's a bull case, there must be a bear case out there. And like the market, there must be some impediment that the market like isn't believing this bear case. So kind of what needs to change in order for sentiment to shift?
If there is a potential recession, there is a concern that AEC could be under pressure since it's exposed to architecture and construction related sectors. That's one. Potentially, if you compare it to the 2008 downturn, revenue fell 16%, so potentially that.
So if there is a recession,
Towards the bear case.
so if there's a recession, does your investment case hold?
So the downside case, I tried to pencil in for my bear case. If revenue falls by 16%, even though it's a more resilient company, revenue falls 16% and they somewhat cut back on costs. And if I cut my multiple to 15 times EV/EBIT, I have 30% downside for the same time horizon.
So it may not necessarily be mispriced, it may be that the market is pricing a recession in, and your call would be that if there is a recession, they won't be impacted as much.
So part of the differential comes from revenue and cost side. So from the revenue side, like consensus pencils in about 11% revenue growth for future years. I have about mid double digits, where that's coming from both pricing and customer growth. So
But is the consensus factoring in a mild recession? Like that, I'm trying to figure out like how your view is different and what the market is pricing in that you're not in your case.
So with respect to what the market is pricing in, I'm trying to benchmark towards consensus estimates to identify the differentiated view. So I think people are underappreciating the pricing story because they have capability of increasing pricing by 5% on an annual basis. Of my conversation, of 12 conversations talk about pricing, and I ask questions of if pricing goes up 10%, would customers switch away? If pricing goes up 20%, will they switch away? And 11 of the 12 say no for the 10% increase. 7 of the 12 say people would still use the software for 20% pricing increase. So I think pricing potential could be misunderstood. I think part of the issue is also there was a 9% revenue growth for, sorry.
No, it's fine.
I just have one other
Take
question.
another question.
So I just wanna get back to this non-paying customer. It seems to me that this all hinges on converting non-payers to payers. And
3.5% of the growth does.
I'm just not sure, like, what's the plan to convert? Like, I'd like, if I had people using my product for free, I'd wanna convert them too. And I'd be very motivated to do so, but I'm not clear on what it will take to do that.
So reading through management commentary about how they talk about addressing the piracy issue, they have increased their emphasis of their communication to investors that they are trying to address it. And because there is some uncertainty here, like management identified a 2 million number. I haircutted that. I took 800,000 through FY26. So I'm not saying there's gonna be an immediate change of all these non-payers converting to payers. I tried to take a more conservative estimate of management's number.
What's the likelihood that the non-payers are happy to use a less sophisticated product? And where you start to impose a higher price and dedicated long-term payments, that they move on to other substitute products? Because they're already utilizing a product that is less sophisticated. I think that's what Jenny's getting at in terms of, your true ability to convert those customers. And then on pricing, when I just looked at the numbers on Bloomberg during the last downturn, it took them 5 years to get back to where they were pre-crisis. Now that was a big housing issue back then. But then you might run into incremental difficulties improving your pricing during that. So just sort of take us through your thought process on substitute products and pricing during a more difficult economic period.
So several parts to that question. With respect to at least revenue growth, it took them 2 years to recover back to their previous level from the 2008 recession. With respect to switching to different competitor products, I think the nuance is how comfortable do you want to be with a competitor product? If you start using competitor product, Google some YouTube videos and you can figure something out over the next week. Or if you want to be more comfortable with using that in your day-to-day job, maybe it's a 6-month ramp-up period. But from some of the customer conversations that I had, I think people described it as a full 2-year investment to actually understand what AutoCAD does and fully implement it into all your solutions. So to stop using AutoCAD and try to use something else, there is a massive amount of time and effort that you need.
I think he's out of time.
Oh, yeah, we're out of time. Thank you, Matesh. Yeah, go ahead.
Ready to go?
Yep.
hit to pitch, Calmain short, ticker's calm. As of last Friday, the share price was $54.50. My target price for May 2024, which is the end of the financial year, is $29. If you add up the dividends till then, that gives you a cumulative downside of 41% my base case. Just quickly on the economic basics, Calmain is a relatively small company. The EV is about $2.3 billion. The short interest is 10%, and as 2% of the market cap is traded every day on average, the days to cover is about 5, which I think for the kind of short that I'm proposing is fairly reasonable. So what does Calmain do? Calmain, in short, is the largest commercial table egg producer in the United States. It produces about 15% of the long-term demand, with its 44 million chickens, and 40% of its sales go to Walmart and Kroger. Two main products, 2/3 of its production are dedicated to conventional eggs. Those are the white eggs. The price of those eggs is quoted on an index called the Urner-Barry Index. And 1/3 of its production is dedicated to cage-free, and cage-free is kind of a broad umbrella that includes organic, free-range, brown eggs. The price there is not quoted, it's much more sort of over-the-counter if you like, and the price is sort of fixed around the $2 a dozen mark. To give you a view of the unit economics, Calmain takes a lot of price. Its major cost is feed, to feed the chickens, and that's corn and soybean meal. And really even buying chickens from the nurseries or packaging and labor, it's not something that they can really control. And as I've mentioned, they already take price, they take the revenue price. So if you can't really control your costs and you can't really control your revenue in terms of the price, then that's not a great recipe for a great company. And so you can see through the cycle their margins are quite low and they tend to be EBIT negative. This is a bad company. So to give you today's context, as I'm sure some of you may know, we're going through a very bad, highly pathogenic avian influenza pandemic in the United States and globally. In the United States, about 58 million commercial birds, that includes turkeys, were culled, and 45 million of those were table-laying chickens. To give you a bit of context, if you run a farm and the USDA know that one of your chickens has influenza and they can test it, prove it, they will go to your farm, take your keys away from you, switch the AC off, all the chickens will, die an uncomfortable death, unfortunately, and then they will compost, the USDA will compost those chickens for you, and then give you the keys back to an empty barn. And so that culling has created a huge supply shock in this industry. And so the price of conventional eggs has gone from 80 cents a dozen to 450 cents a dozen. As you'll see, the price is starting to crack. It's the only pun. Say that. But this is not implied in the price, right? If you take the market cap pre-pandemic and the market cap today, you give the company credit for the cash it has on its balance sheet, you get about $700 million. That's kind of the normalized free cash flow you can expect, more or less. And over the last 2 quarters, this company's made $100 million in free cash flow, 8 times its average rate. So really, if you just divide those two, the implied normalization is about 7 quarters. In my model, I have it 2 quarters. So that gives you sort of an idea of where the market's thinking relative to the stock. And so to believe that, you have to believe, like the sell side does, that the price of eggs is going to remain around 100% above its long-term rate for years. And I don't think that's reasonable. And the reason why I don't think that's reasonable is because we have a proxy. 2015, same issue, highly pathogenic avian influenza, 30 million birds culled between April and May. The price shoots up, the stock price reacts, as you can see. But over time, the flock recovers naturally. And as it reaches the then supply-demand balance of 310 million layers, the price normalizes, stock price normalizes. And I think the same thing's going to happen. So really, you're looking for signs of recovery from HPAI. And we have them, right? Year to date, there have been no major outbreaks in commercial table egg laying facilities in the United States. And there are 3 main reasons that I can advance for that, based on my conversations. The first is that migration of wild birds is seen as a main vector for this disease. And as you can see from Birdcast, this is birdcast.com, it's a lot of fun. I recommend it to all of you. There's no real bird migration at the moment. And so that's a major vector that's been eliminated that propagates this virus across the United States. The second is that scientists didn't think that this, they were surprised that the pandemic was lasting so long through the autumn because they didn't think this virus could survive the cold. But it's been very cold. So that could be another reason. And the third is that if you're a farmer, you don't want to lose all of these birds. You're not compensated adequately for it. And all of your competitors are making money from your birds dying. And so farmers are wising up and they're building buffers between the outside world and the inside of their barns. And so that all of those things, I think, give me comfort in this, in us being towards the end of this pandemic rather than in the middle, which is basically what sells up. And so if you just take the 307 million birds laying eggs today and you give their normal replacement cycle, their normal culling cycle, and you just run them all, basically the flock should normalize to 320 million, which is today's equilibrium for supply and demand, by the end of May of 2024. And so those 7 quarters just don't seem realistic anymore. Not only is cow Maine, in my opinion, a cyclical overrunner and deserves to be shorted purely for that reason, it's also a burning platform. Major states in the United States have already banned caged production of eggs. California, Massachusetts, and it's spreading across the nation, 25. I've seen on the left-hand side here. And so the big retailers are following suit. Walmart, Kroger, remember that's 40% of cow Maine sales. Said in 2015, by 2025, 100% of the eggs that we sell in our shops will be cage-free. Now, cage-free eggs have been historically twice the price of conventional eggs, and so the customers haven't really followed. Now they're actually cheaper. So they've had to walk back a little bit and said, okay, well, let's try 70% by 2030, and Kroger said 54% by 2025. Again, not priced in. If you take today's book value and you adjust for either that 54% target or that 70% target, it takes $45 per head of capacity to switch. If you just run the math, you get 30 to 55% downside. And that really is the genesis for my valuation. Price target's 29. I just take my predicted 2024, so that's May of next year, book value of $28. I adjust that for that conversion factor, which is at 13.5, you see at the bottom. Apply a twice price to book multiple, which I think is generous and fair. And that gives you a 29, and you add in the dividends, and that gives you that 41% downside that I gave you at the top. The ball, how do we lose money? Well, we lose money if the market basically keeps thinking that this cage-free conversion is a myth, it's never going to happen. And so they just basically grow their book value, they assign a bigger multiple to it, and that gives you that upside at $67 a share, which is where we were when I started looking at this stock in September, October. And that's 23% upside plus the dividends. In terms of the signposts, there's a lot of data. This is a great stock to monitor because there's a lot of data from the USDA and from various private organizations. But really the two big things here are, is management going to unduly return capital? They're just going to flood us with money that we're going to have to put up if we're short. Or is the HPI going to flare up because it either went endemic, it's in the ground around the farms, or because it restarts in the spring because we haven't done the migration side. I'm happy to take any of the questions.
I think some of your statements were extreme. Sorry, this is rare to point out. My serious question is, if you think about companies in the agricultural world, oftentimes they'll hedge the inputs and the pricing such that really all they're looking for is a spread, and they can keep that spread somewhat consistent. I agree that cow Maine has been up and down for years and years, and this is the latest example. What is it that they haven't been able to hedge? What financial product is lacking for them to be able to have effective hedges? And what could change in that dimension such that they could look like a more traditional producer where they lock in the margins and take a lot of the volatility out of the business.
Yeah, there was a great, it's funny, I was researching this stock and everyone's flooding me with jokes and podcasts. And one of them is Odd Lots by Bloomberg, and they had a really good interview with a man who was saying exactly that. He was saying, I cannot hedge the price of eggs because the product doesn't exist. Historically, I think the Chicago Board of Trade was Chicago something, an egg or something. But they withdrew the options on eggs in the 80s. So you can't actually really buy futures on eggs. So you can't really directly hedge it. On the input side, you can of course hedge corn and soybean meal, but they're at historically high prices. And some of the futures that are feeding my model, because of the situation in Ukraine and the really bad weather in the US, both corn and soybean have been affected. So the prices are really high. So they're kind of locked in a situation where they have to hope that everyone else's chickens have issues, not theirs, and so they eat, they take the high price, while the situation normalizes in other parts of the world, so that their input price decreases.
And in the existence of an earner barrier, whatever the index was,
Yes.
that sounds like that's one step away from something that somebody could have futures
Yes.
around.
So what I'm saying is there used to be futures, but they withdrew it. I think they withdrew it because the concentration in the industry is so large that there was manipulation.
And is management trying to work on anything?
Honestly, I don't think so. I was a bit nasty with management on the next slide. It's a management succession through marriage model that they've adopted. But they're not, I don't think they're really thinking about how do I make this the most sophisticated company in the world. I think they're just running it. There's a dual class share structure. I think they're just running it for dividend. I think they could do what you're proposing. I think they just.
Seems like somebody in school here at Columbia could help.
Yeah, but we haven't recruited to chicken companies very much. Yes.
So you see the situation changing in 24. One of your risks is capital return.
Yeah.
So you do adjust the target price for dividends, but could they build up a lot of cash? They don't have any debt now.
Yeah, so I'll give you the net.
Is there just how big is that risk of a special dividend or
Yes.
some type of?
Okay, so today they have, and I have it on the first slide, about $6 and a bit, I think, of cash on the balance sheet.
For sure.
Yeah, per share.
Yep.
So that's a 9. 11%. Which is similar to actually the dividend action that I have for my bull case. So, and obviously those things are not mutually exclusive, you have to sort of. But I think the really fun and good thing about this short is they have a real important use for that cash. So they could say, sure, we'll return, we've made a lot of money, we'll return all the cash. But because of the economics of their business, I don't think they can take on debt. I think they would be, it's an EBIT negative business most of the time. Having debt just doesn't, as a manager, that wouldn't make a lot of sense for me. So I think they're going to keep that cash and plow it into conversion, which I think works for us.
Do you think there's any risk that someone comes in and acquires this company because they view it as a scarce asset, or we have seen some of these companies taken out through acquisition over the years. So.
Yes, I think they could, but it'd be very cheap. No one's going to come in, and the shares are trading pretty high historically. It's a company that produces basically no excess economic value. They could be taken out, but I think the value of that transaction is going to be okay for us to manage. In terms of, and I think a big thing is that conversion. If you really wanted to be in the chicken egg business, you could just build cage-free facilities by yourself in the South or in the Midwest where they are, rather than buying facilities that you then have to convert, if that makes sense.
So you don't think there are barriers here in terms of?
I don't think there are any real barriers to entry
Yeah.
to this business.
And did you look at like Pilgrim's Pride or any of those companies that were taken out by competitors?
No, it's not something I spend a lot of time on. That's interesting. Yes?
How did you spend much time thinking about the risk that the egg prices go higher? And what are those sort of dynamics like? Like sometimes in commodity markets, the supply difference of 2% means a price change of 20 or something.
Oh, yeah.
If the bird flu ends up being worse than you think, I don't know why it would be, but, is there a risk that the price of eggs goes up 50% or something like that?
So in 2015, the price of eggs plateaued at about 200 cents, $2. That's double. So yeah, that dynamic played out exactly. The supply got hit more, 45 million birds instead of 30 birds, and so the price reaction was extreme. I think for the price to go even higher, bearing in mind that it's cracked already, it's dropping, is that HPI would have to kick off again, and you know the pandemic would have to flare up again. And I think the evidence for and against that are just not weighted equally in my mind. If that makes sense.
I don't know where they sit on the cost curve relative to the rest of the industry. It wasn't clear to me. And I think your argument here is pretty compelling. But I would just note that there's over $1 billion worth of capital invested in this business, right? And if they are a low-cost producer, right? Maybe they're scaled, makes them a low-cost producer, I'm not sure. And they're gonna have to invest more capital in order to do the conversions, and the rest of the industry is going through the same thing. You could end up with, I don't know, a few $100 million more. I can't remember what the math is on how much they have to invest. And then if you put some basic level of return requirement on it, I don't know what it is for an agricultural company, Tom, maybe you know, but let's say it's 12%, you get an after-tax profit stream at a pretty low multiple that gets you a share price not far below where it trades. I'm not saying that's going to happen.
Yep.
But it's just one sort of angle to look at this and say, okay, how much capital does it really take to run this business?
Yeah.
And if somebody's going to demand a return, then what is the underlying value of this business?
Yeah. Tangential to that argument are two main points. First, the work today is terrible. So that revenue stream does not exist profitably, right? There's no value to grow. I did do that comparison side by side. And there's a great paper by a guy at the University of Iowa. They have this research center for eggs, and he did this sort of side by side economics, and he said, oh, yeah, but cage-free is so much better. The problem is, Calmain has to license the brand, their labor costs are going to be higher. Actually, I did this quite conscientiously, the unit economics for cage-free aren't better, so it's still going to be a terrible company. So my argument is that they're going to pay a lot of money just to recover the revenue that they already have, which is not good.
This is a commodity business.
Yeah.
What is normalized return on capital of a business like this?
I don't have great comps. I couldn't be able to tell you what Tyson do, but I'd imagine it's high single.
Well, Tyson's also has branded goods. These guys don't have branded goods.
Yeah.
Okay. Yeah, that was my only question. But I will say this: if you're going to base your valuation on tangential return on capital, first of all, you have to adjust the capital to cash because there's a lot of cash in there. Then you take that capital and you comp it versus other agricultural companies, and that is your target price, whatever the average of the industry is, and that's your multiple of the targeted return. Like if it's a 15%, the industry average on return on capital unleveraged is 15%, then you can argue that it's worth 2 times the book.
Yeah.
Argument. You have to adjust it for cash. You didn't adjust it for cash. You just said book value. But I see 300 million in cash, so you have to adjust it for cash because.
Okay.
Right. So I would just approach it like that.
I appreciate it.
Do that math, what do you get?
I don't know.
Well, the return on the industry can't be 15%.
Well, I did it for 12, and I got a market cap plus the 380 million in cash of 2.1 billion, right? So the spread is lower than what's implied by your target price, but it also reduces the time frame necessary to generate excess cash to where you could build up to the current $55 share price. It was just sort of a
It's interesting.
backwards financial check.
Yeah.
And I don't know if 12 and a half is the right 12%.
I suspect it's a little lower, but it's not gonna be enough to change your.
Can I just ask one other question really fast? Do they have any long-term contracts with any of their Kroger or Walmart or anything?
The disclosure on that is terrible. What I did try and do was model the price versus the Ernest Barry type price versus the price that just is implied by their revenue. It's slightly above, but it's compressed during this price fight. So my view is they probably do. They lock in some of the price, but because the price is so high, Walmart can shop around and get what the Ernest Barry's are.
And then the last single quick question, $45 a head to convert from white to cage-free, is that a one-time cost?
Yes.
And what would it cost me to open up my own Jenny Wallace eggs, cage-free per head?
A fraction of that. I don't have the exact number.
Fraction of $45.
That's what I heard in my mind.
All right, we're way over time. Thank you, Jeremy.
Be different.
All right, John, whenever you're ready.
Awesome, thank you. Good evening, everyone. From chicken, we move to whiskey. My name is Shalat Doshi, and I'm going to recommend a short position on MGP Ingredients. Ticker MGPI, market cap $2.1 billion. My 12-month price target of $63 represents about 35% downside from current levels. I expect about 30% downside to Street's 2024 EPS estimates and about 3 turns of multiple contraction. So a quick background on the company. MGP has 3 main divisions. The largest is Distilling Solutions, where they do contract distilling of various spirits. Whiskey is the biggest product, it's about half the revenue and 70% of gross profit. So they've basically made and partially aged the liquid that goes into these bottles, and then someone else slaps the label onto it. This is about 55 to 60% of group sales and gross profit. Next is Ingredient Solutions, 15% of sales. Not a very important division for them, which is food-based proteins. And finally, Branded Spirits, which is about 30% of sales. This is a company-owned portfolio of spirits brands in this division, and was formed by the acquisition of Luxco in the first quarter of 2021. Now, the US American whiskey and broader spirits categories have grown rapidly over the past 2 decades, and they've taken share from other alcohol categories, notably beer. And within American whiskey, 5 companies hold 80% share, but the remaining 20% is a long tail of many brands, and this was due to a rise in whiskey demand over the past decade that led to many smaller players entering the market. And as they were ramping up, they needed capacity, and which again led to a need for contract distilling, and this is what led to the growth of MGP over the past decade, about a 30x increase in their share price. However, over the past 2 years, MGP has sort of caught lightning in a bottle. A lot of factors have benefited its growth, and I think it's an interesting short setup. I believe factors related to an oversupply of aged whiskey, competition, weak macro impacting the demand, and a poor acquisition along with commodity inflation is going to result in significant downside to Street's unreasonably high expectations across all of its divisions. Let me go through each of these points in detail. My first point is on supply. I think there's going to be a glut of aged whiskey supply in 2023 and 2024. Now, whiskey is typically aged for on average 3 to 6 years. So a key feature of the whiskey industry is that demand follows supply by 3 to 6 years. So I looked at production trends between 2017 and 2020, and from conversations with whiskey brokers and traders, and touring bourbon distilleries in Kentucky, I found several supply-related trends that were going under the radar. The first one is the overproduction during the pandemic by large producers. So producers like Brown-Forman, who considered essential personnel during COVID, they were making hand sanitizers, and they could not just turn off the tap. So that ongoing production led to a lot of excess capacity being put into barrels into storage. There's a lot of 2 to 3 year old juice building up there. Second is, many large distilleries opened around the 2018 to 19 period, and their barrels are maturing now as they hit the 4 to 5 year old period. And I noticed this on some of my tours. And finally, most interestingly, is the financial investors piece. Seeing that aging of whiskey produces 2 to 4x returns in 4 years, which is like 40% IRR. Many investors started to buy, financial investors started to buy whiskey and age it themselves. And they're now hitting the sweet spot of returns. So any incremental aging will reduce their IRR because the value of whiskey reduces after the 4 to 5 year old period. So we're going to see all of these factors result in a lot of supply coming onto the market. And all of this is on top of the capacity expansions already announced by the large players. Now, this has happened before for MGP and very recently in 2019. And again, both management and brokers were late to anticipate this. Based on my estimates, a drop in the value of aged whiskey back to normalized levels would create a 10% decline in group gross profit. If this thesis point alone plays out, the short works, and there is sufficient downside to streets' expectations from these levels. My second point is on there can be a 10 to 20% revenue impact from loss of customers through insourcing and competition. So now every whiskey brand wants to be able to make its own product, and contract distilling is supposed to be a means in the ramp up phase. MGP does not list its customers, but several of its customers, which I found by if you look at the label at the back, it's written distilled in Indiana. They launched their own distilleries around the 2017 period, and they'll be able to make their own aged products soon. Notably, Bullet, which is their largest customer from Diageo. And it's not just these. If you look at industry data, there was an unusually large amount of capacity investments by the industry in 2018 period, all of which are hitting the maturity phase right now. And MGP benefited by being the only contract distiller out there for a long period, but no longer. The most notable competitor is Bardstown Bourbon Company. It launched about 5 years ago, but it has already captured 70% share of the Kentucky contract distilling market. Now, brands want to be associated with Kentucky, in the bourbon industry, and they also get a better ROI there. And you can see many MGP, customers hide where they distill, like Angel's Envy here. And I think, Bardstown will continue taking share from MGP. They recently launched last month, their own rye mash bill with the same, mash bill as MGP's rye, 95%. And, this is going to continue the share trajectory, basically. Now, the customer loss component is not part of my base case numbers, but I think it's a major and plausible risk, which is why I wanted to call it out upfront. My third point is the impact on demand from macro in what is a cyclical industry. So there is a COVID over-earning or pull-forward element to this. People built home bars, filled their liquor cabinets. And this led to a 30 to 40% increase in at-home whiskey consumption during the pandemic. As that unwinds, and we have met with a period of recession and inflation weighing on the consumer's wallet. And in the past, we have seen recessions have a significant downtrading impact on the American whiskey category. And MGP's branded spirits portfolio, 35% of that is premium, could see a significant reduction in volume and price. The impact to MGP's distilling solution side comes from its high craft distillery exposure, analogous to an SMB exposure. And these are again the worst hit during recessions, and many go out of business. Now, my fourth point is that their branded spirits bull case is invalid. So MGP spent about $500 million to acquire Luxco, and it painted its picture as a premium whiskey portfolio, but far from it. I don't know, judges, if you ever tried Everclear. It's a $20 spirit, has a higher alcohol content than hand sanitizers. College kids use it in jungle juice. That is their highest selling product. That is what their portfolio is representative of. And it's Luxco is dilutive, EBITDA margin dilutive to the business, and scaling it will require more and more investments, and it's unlikely to ever reach the gross margin levels that peers like Brown-Forman have, which is 60%. So this is important because I think not only is MGP going to miss on the gross profit level, but also on the EBIT level because of these investments. Another bull case is that MGP can use its contract distilling liquid and sell it via Luxco, the branded side, and get much higher margins. But because their locations are different, Indiana and Kentucky, Missouri, they're not able to do that. So a lot of their success now depends on M&A capabilities. which they neither have history nor expertise in pulling off. Quick point on commodities, they lock in contracts towards the end of the year. They enjoyed really favorable rates last year, but their 3 top commodities hit decade highs, last year, and they're basically going to make zero gross profit on 13% of their sales. So tying all of these into my numbers, I think you're going to get a 30% downside to 2024 EPS. And MGP is trading at a PE that is above Diageo and Constellation brands. For a cyclical company with poor brands, I think that is ridiculous. And, the multiples actually come down quite a bit since I first pitched this in December. But if you use a more normalized multiple of 16x and use a sum of parts valuation based on transaction comps, you get a $63 price target, which is 35% downside. There are also other red flags related to management compensation, leadership changes, and an uptick in insider selling, which I'm happy to discuss further. The key risk to my short, I think, is timing. We can go into detail further in Q&A. Thank you.
Are any of the Luxco brands, it seems like there's a lot of them, any of them doing particularly well or really ramping? And I guess the other is Bardstown. Are there any other startup contract manufacturers in Kentucky?
Yeah, so on Luxco, broadly in their branded spirit side, the brands that are doing well are the ones that they had internally developed before even acquiring Luxco. So that is, the Davis County, Rossville Union, those are the ones that are doing the best. And Luxco has like 50% of its portfolio is actually not even in whiskey, it's in tequila and other categories, so which are all lower margin stuff. So they are actively trying to get rid of these lower margin brands, and the latest Nielsen data for December showed that they are losing share in Luxco to the other bigger players. So they're not doing well.
But of the ones that are doing well, are they doing really well, or they're just kind of doing
It's like none of them is a rocket ship. They're probably doing, in line with the rest of the industry. One thing I can say is, they got lucky with one of their brands called Yellowstone because of the TV show's popularity. They just rode on that bandwagon. But other than that, Luxco is, the recent Nielsen data shows it's pretty negative. On your contract distilling side, there is no other player out there. And Bardstown being in Kentucky and having that scale is something that's really helped them quite a bit. The big producers, so Heaven Hill, Brown-Forman, all of these guys also do some amount of contract distilling that they don't disclose, but again, it's for very small brands, it's not a big part of their thing. But Bardstown, this is one of the key parts of their strategy, from what I understand. That could be a bigger risk.
You said towards the end of your presentation that on a third of their sales, that they're gonna have zero gross margin?
Yeah.
Can you just review that?
Sure. So I meant 13% of their sales.
13.
Yeah, 1-3. So to clarify, they were already making pretty poor margins on these. So they were making low single-digit type margins, but their 3 top input costs are wheat, corn, natural gas. All of them have spiked up considerably. They lock in these contracts at the end of the year. So 2022, they enjoyed like 2021 rates. And now for 23, they've locked in 2022 rates. You can just assume that 13% is, they're not going to make any money out of that. But again, why this is not a key part of thesis, it's a very small portion of that. So this is industrials, white goods, fuel, those kinds of alcohol that they make.
Is it possible to pitch the idea in that they put this inventory into the aging process,
right,
and they expected X.
Yeah.
And now they're gonna get Y. Is there a way to define it that way?
Yeah. No, I've been trying to do that. So there are 2 issues. The industry is notorious for being secretive about the supply and sourcing contracts. There's no clear number out there. So this is actually one of the popular bull cases on the stock is that, they have all this aged inventory that they can just sell for, whatever. Like if they sell all of this aged inventory, it's at $20 EPS, and so the stock is trading at 4x, not at whatever. But the argument is that you have nothing to sell for the next 4 years. So you're making 0 EPS in years after that. And the math on that is difficult because you're putting stuff for aging like 4 years out. And again, it's a combination of whiskey and other categories there. they made an acquisition, so that distorts some of these amounts. So I think that would be a great way to put it, but I just don't have the concrete numbers behind
Just so record keeping, on slide 23 of what we got, I think your slide numbers are different.
Yeah.
Free cash flow goes up. Those are your projections showing free cash flow going up?
Yeah, so I think, I'm not saying it's not gonna grow, I think the company will grow modestly, but yeah, they don't need, significantly higher capex levels, and I think the short is playing on that. The street is expecting this bourbon boom to continue, and this has been like a pure play on playing the bourbon category. All of the others are and I think that has been overestimated. Their growth, top line growth, which was at 60 teens to 20s in the last couple of years, that should come down to low single digits, and their free cash should sort of flatline from there. So yes, they will keep growing, but modestly, not significantly.
So how do you envision this unfolding? Like, it's not gonna be, like with short selling, it's like you're trying to identify a ticking time bomb and you need to know exactly when it's gonna go off.
Yeah.
It seems like it's not like we're gonna wake up one day and they're gonna be leading out people in handcuffs. So
Yeah.
it seems like it's gonna be more of a slow burn.
Yeah.
Like, so how do you envision the catalyst? Like,
Yeah.
is it gonna be they come out with earnings and the stock is down 20%, or is it just?
Yeah. So, I mean, I think that is the the key risk to my short is what I'd say, that it might be a slow burn. Like, this might still need a couple more quarters to play out, but to monitor this, I think a couple of things. The supply related points that I spoke about. One of the brokers I spoke to said he knows one customer who has 100,000 barrels lying there, and he wants to dispose them. Any news of a major dumping of supply would be the first catalyst that, I think prices peaked and this is happening. That's one. MGP has done this, like when it happened in 2018 and 19, it wasn't a lot of external information, but quarter by quarter, MGP saying, oh, we're downgrading. Oh, I think, the 4x value we get on aging of whiskey, that's actually come down to 1.5, 2x. So MGP's commentary also, is part of it, but yeah, it's, again, all the players in this industry are private and MGP is the only one. So I think news flow and MGP themselves disclosing about this is the only way the catalyst will play out.
Yeah, it sounds like in order to verify your thesis, it's gonna be kind of difficult because it's not like you're gonna get a clear signal that your thesis is working out.
Right. Yeah, I mean, again, so there is no one, as you said, like an egg price indicator that I have here, but it's definitely, and again, unlike other commodities, whiskey does not trade on an open marketplace. So a lot of this information is by asking brokers, what prices are you guys selling at or what's happening, and that's not as liquid. So you're right, it's something that will unfold slowly, but there are multiple indicators pointing to that this is going to happen in this year, in the next couple of quarters, and so I think it's an interesting thing.
I'm curious, how far back did you look at this? Because from like 2014 to 2018, the stock price went from like 12 to 100 on essentially flat sales.
Yeah.
And you said that it's trading at a ridiculous multiple.
Yeah.
I don't know, for many years it traded in the 30s.
Yeah.
And what's to stop that from happening again?
Yeah.
A. B, in 2018, the stock price got cut in half.
Yeah.
Again, profitable, cash flow positive, very hard to tell, just looking at like a value line, which I'm doing.
Yeah.
What drove that? Can you walk me through kind of like what's to stop it from going from what you say is a ridiculous multiple to a further ridiculous multiple?
Sure.
Because it's already done that.
Yeah.
A. B, when it did fall in half, which would be very good for your thesis, what caused that to happen? And are there any analogies that you see today that could be similar?
Sure. Yeah, I mean, I actually found this idea because I was studying its history. So between 14 and 18, so the company's strategy has been to move to higher and higher margin and value products. So initially till 2011, they were only doing these white goods and low single digit margin businesses. From 2011, they moved into whiskey, and they sold only new distillates, so not aging. So that is one value. Then from 14 to 18, so they got a new CEO in around 2013, 14. The strategy was to move from the new distillate to the aging of whiskey model. And that got a lot of attention, a lot of popularity. Initial results were also very positive. One thing to note is this company had only 2 brokers covering it, smaller. Before that, again, it was a small cap. There is no peer out there, and the demand was shooting off the roof. The bourbon industry was growing high single digit, low teens. This was the only player out there that was only doing bourbon and moving, from a low value to a high value player. So all of these things sort of combine to improve its value. I think those multiples are, might be misleading because I don't know, if like forward-looking multiples might not be reliable there because the estimates are on a very small base. But yeah, why it might not happen today is it's a different scale of business. It's much better understood. What happened in 18 also was that supply. These comments started coming out. Every quarterly result, the company started saying that they're not getting the target value uplift that they want in their aged whiskey.
That's what caused the stock price to fall.
That's what caused the stock to fall 20% in 3 consecutive, quarterly results, basically. So it's a very similar setup right now. The company is saying we've acquired a branded site, so that was again part of the decision to move up the market. And that's why they're saying it's different this time, but majority of their profitability still comes from the aged whiskey side. Like if you
Shalan, thank you.
Yeah.
That would be very well informed. Thank you.
Bring it up to share with the whole class.
Hi, good evening, everyone. Thank you very much to the judges for coming out, and thank you to Meredith and Julie for organizing. My name is Bryden Nugent, and tonight I'm pitching a company called Simpson Manufacturing. I'm pitching it as a long for a 20% 3-year IRR with a price target of $190 at 2025 year end. There's 3 parts to my thesis. Number 1, I believe the market expectations of gross margin declines are too pessimistic. Number 2, I believe revenue growth projections are also too low. And number 3, I believe the valuation, despite being slightly above peers, is actually very attractive when you consider the company's very impressive operating metrics. The company is a $5 billion market cap, and it's in the industrial space. I'll start with an overview of the business. So Simpson designs and manufactures structural connectors and fasteners, which is basically a fancy word for screws and bolts. These products, there's some shown on the left there. Their major product is something called the Simpson Strong Tie, which sits at the joints of a wooden frame house and holds the pieces of wood together. They sell for about a couple of dollars a piece, and altogether, you're looking at about $1,000 worth of Simpson content per home versus about $300,000 total cost of the house, so about 30 bips the total cost of a home. They also have very high market share in some of their larger end markets, so close to 80% in U.S. residential wood connectors. This slide here, I'll spend a little bit of time on because I believe it's very important for the rest of the thesis. So, looking at this company originally, I thought this looks like a commodity product, basically stamped pieces of metal. How are they keeping these high market shares? How are they earning mid-40s gross margins? And how are they maintaining this price premium over competitors? I basically found 3 things. Number 1 is just the mission-critical regulated nature of the product. The joints are the weakest part of a structure, and there's actually a lot of regulation over which connectors you can use in a structure. So architects, when they're designing a blueprint for a home, often want to use the blue chip brand name product, especially because it's so cheap compared to the overall cost of the home. and also because they actually have legal liability if there's issues with the home or if it collapses. Number two is just the complexity of the market. So building codes in the US are notoriously complex. They vary state to state or even county to county, and there's additional requirements if the area is prone to natural disasters or earthquakes, things like that. So as a result, Simpson sells around 14,000 different products and spends around 4% of sales in R&D, which is quite high for an industrial company. And then finally, I think the most interesting one here is what I've heard called a friendly middleman effect. And basically what I mean by that is Simpson understands that its two key customers it has to keep happy are number one, the architects, and number two, the builders. So to address the architects, Simpson has built out a network of 750 customer support engineers. So if you're an architect, you're designing a building, you can basically call Simpson, give them a zip code, and they'll tell you exactly which types of connectors you need and which product will meet that specification. So this saves a lot of time and hassle for architects, and they're happy to pay this premium because they're basically passing that cost through to the homeowner anyways. To address the builders, if you speak to home builders, which I've done, their number one pet peeve is when a missing $2 connector holds up an entire construction site. So to address that, Simpson has built out a logistics network that can ensure that around 98% of products can be delivered within 48 hours. That is head and shoulders above peers, and that's actually a KPI for managers or some managers at Simpson. So I believe all that, basically, it's not obvious when you look at the company, but it gives them some pricing power that isn't necessarily appreciated by the market. These are some quotes, I'll skip over those in the interest of time. This is just a great example of Lowe's, which is about 25 times larger than Simpson in terms of market cap, trying to compete in this market and failing. So Lowe's in 2012 dropped Simpson products and tried to make their own version. They began to lose customers from the high-value professional segment, so professional builders, and in 2020 capitulated and returned to carrying Simpson products. You can see a great quote here from the Lowe's CEO around that time, basically saying they need to carry these products to have credibility with the professional segment. So that's the barriers to entry, and I'll move on to my first thesis point. This is on gross margins. Basically, Simpson's largest input cost is steel. If you plot the historical steel price shown in black versus the gross margin, you can see that there's about a 12-month lag usually between peak steel prices and trough gross margins at Simpson. Steel prices rose by about 50% during the COVID rebound, and essentially the sell side has been waiting for the other shoe to drop, so to speak, on Simpson's gross margins. The sell side is plotting this shaded blue line as the gross margin forecasts going down to the high 30s. My hunch is that they're just plugging in, or a lot of them at least, are just plugging in the GFC level gross margins because they looked similar then. But I think this analysis is too simple and ignores a lot of other factors. Number one is that 12-month relationship. If you plot that out, that would suggest that the trough gross margin pressure actually occurred about 6 months ago in the third quarter of 2022. Number two, if you look at how much Simpson has actually raised their prices through COVID, my estimates are that they're about 30% higher, 34%. Steel prices, meanwhile, have reverted back down to only 5 or 10% higher than the 3-year pre-COVID average. So when you look at a 30% price increase, 5% input cost increase, to me that doesn't suggest gross margin pressure, and if it is, it should be short-lived. And then finally, the consensus expectations are just very bleak to begin with. They have margins falling close to 10% peak to trough, and even in the GFC, they only fell around 5%. Excuse me. Moving on to the growth forecast, this second thesis point. Essentially, I won't go through the slide in detail, but the key drivers are obviously housing starts, about half or 2/3 of revenue, depending on how you count it. I have simply used Fannie Mae forecast there because I'm not trying to make a call on the housing market. So that's about a 25% decline next year, followed by a 12% rebound. So that's about 50% of the exposure. The remaining 2/3 of the exposure. The remaining is commercial, and that just means GDP growth there. And the next driver is pricing. I believe those barriers to entry we discussed earlier give the company substantial pricing power and gives them the ability to grow through price increases through an upcoming housing downturn. So I've modeled 3% pricing growth each year. And then finally, there's a little bit of an M&A effect for 2023. So you can see I get to forecasts of -8% this year, 13% rebound the following year, and then 6% per year thereafter. This is just discussing what Simpson says about their growth. So if you look at their strategic priorities, they say they want to grow above the rate of US housing starts while maintaining top quartile ROIC and EBIT margins in the top quartile among peers as well. These graphs are basically showing that they've achieved that easily over the last full cycle. The left showing revenue growth has outpaced housing starts. Those are rolling 10-year numbers. The middle graph showing EBIT margins, and then finally ROIC, which is averaged in the high teens. This is some of the growth levers I think they have at their disposal. Pricing power, we've already discussed. There's some new markets they've identified. Each of them has a TAM from about 100 to 700 million. And then finally, share gains. So if you look at, they've been able to gain about 1.5% market share organically over the last 4 or 5 years. I've assumed that continues at half the rate it has in the past going forward. So you get about 80 basis points of share gains per year, which I've modeled. I have a bit more evidence on that I'm happy to discuss as well. And then finally, one tailwind on the growth point. This is just looking at, if you look where people are moving, which is the far right graph, people are moving to the Southeast, Florida, Texas, et cetera. And those areas are actually more prone to natural disasters. The content per home in that Simpson sells into can range by a factor of up to 10x. So you're looking at potentially up to $3,000 per home. And I think this could be a tailwind as well, sort of demographically, but I haven't tried to model it. So this is just my return scenarios. My base case, again, I have a 20% IRR. That's based on a 17 times earnings multiple. Bear case, I'm happy to go through in more detail as well, but this basically assumes GFC level of housing starts and a very low valuation as well. This is just plotting out those housing starts. The Fannie Mae ones that I've used are the shaded bars, and then the bear case is the black line, again, about in line with the GFC. On valuation, very quickly, you can see they're at about a return premium to the S&P 1500 Building Products Index. That's actually lower than the historical average. And when you look at their operating metrics, they've got a 15% premium in terms of gross margins to that index, 10% EBIT margins, higher ROIC, lower leverage. So I think that's a completely justified premium that they're trading at. So that's essentially our presentation. I'll just make one last note, which is if you've looked at the consensus expectations the last few days, you'll notice my numbers are actually below that. That is basically because this presentation was due Monday. After I submitted it, they reported and raised guidance quite a bit. So, and particularly the gross margin actually. So, you know, expectations have come up a bit, and now mine are a bit below that. But I didn't want to change the presentation between the deadline and now. So, thank you.
I thought the investment case held together very well. So actually, I have two questions. It seems like most of their sales are in the US.
Yeah.
Overseas, who do they compete with? And do they have quality products overseas? And is there any risk of some of that coming back to the US? And then the, well, I'll let you answer that.
Yeah, I'm not sure about the foreign competitors too much. I think their other big market is Europe, and I think Europe is very fragmented. They just made an acquisition over there, which we'll have to discuss a bit more, that's pretty focused on France. So I imagine it's sort of regional competitors depending on it, but short answer is I'm not sure. As for them coming into the US, I'm not too worried about that. I think these market shares have been pretty stable for like a decade or more, basically as far as I can find data for. So I don't really see a reason why that would change, especially when you think of all those moats that we discussed.
Okay. And then the other one is, you may not know the answer to this, maybe a little esoteric. On the bigger home builders like D.R. Horton, Lennar, is the market share different with the larger home builders than it is with like the mom and pop home builders, or do you know?
I'm not sure. The only thing I've seen as for differences in market share are regional. So I think MyTech, which is their largest competitor, it's about 10 or 15% market share, owned by Berkshire Hathaway, is more regional. I don't know which regions, but versus Simpson has a national presence, which helps with the big box retailers and such. So I don't know about size, but I do know geography can really explain it.
On slide 8, in 2023, you talked about growth declining is there anything in the guidance that the update that you just talked about that would change that?
Yeah, so the guidance, basically there were two big findings it came out like Monday night. One is that gross margin, guidance was higher, and that was very supportive of my thesis, and brought up all the estimates quite a bit. They did say they're going to lower some prices in some of their markets, so I would say that thesis point wasn't supported by that.
The 8%. Are they, do you still?
Oh, they don't give sales guidance.
But do you, post that, are you still?
I guess I would probably lower that. But I guess this forecast overall, it's a 3-year forecast, 3% a year. So I don't think it necessarily destroys the full.
Pricing.
Oh, I'm sorry.
Growth, revenue growth.
Yes.
Are you still at a -8.3 for this year after listening to that?
I would probably lower it maybe 1% or 2% because of that pricing impact.
Okay, so it's funny, so my next question is about pricing, because on the slide before, you said they've raised price 34%, and so, yeah, I was gonna ask you, do you really think they did?
Yeah.
I know it's a kind of niche thing, but still, okay, so they.
Yeah, no, I mean, it's a good point, they have raised price a lot. Oh, sorry, go ahead.
So I'm just kind of wondering why, when you put the project together in the fall, the housing market was taking some hits, I mean, it was pretty clear. I just kind of wonder why maybe step aside, let the numbers settle. It's obviously a good company with a really interesting position, but you're kind of in the heat of the storm.
Right.
In the middle of the storm.
Right. So yeah, when I submitted this pitch, I think it was like late November, that it was a lot cheaper. Home builders in general were a lot cheaper, and so a lot more of the pitch kind of focused on that valuation. Since then, home builders rallied a bit, but also the outlook for the market looks better. So, I think those two things kind of equal each other out. So I think, yeah, I mean, I think like obviously things were like cheaper a few months ago in this space, but obviously the outlook has changed too.
But the housing market's still a little.
Right. Yeah, I mean, I think the other way of thinking about this is I think if you want to wait.
It starts, I mean, just starts.
Right.
And the home building optimism.
Right. I think if you want a way to play like the housing market recovery, and that's been a controversial area for the last 8 or 12 months, I think this is a much higher quality company than the typical companies in that space, and so maybe it's a potentially safer way to play that. I think that's one way of thinking about it. Yes.
Can you analyze the capital allocation decision to buy the French company? Is that a good deal or a bad deal? And also, I noticed on the earnings that there was some management turnover, a fair amount of management turnover, actually. Can you talk about that?
Yeah, so on the acquisition, that's basically the way I think of these risks. The first two are the larger risks, and the third one I'm not as worried about. They acquired this company about a year ago exactly. I don't think there was anything wrong with the acquisition other than pretty terrible timing. It was kind of like peak housing cycle, peak multiples, and raising their Europe exposure right before the Ukraine invasion. So that's sort of unfortunate. But it's a very high quality business. It's rare to find businesses with similar margin profiles in this space, and they sort of waited for that. They have a similar kind of dedicated engineering team, and it's done pretty well, since the acquisition so far. It's only been a year, so. Other than the timing, I think it was a good decision. On the management, they did just have a new CEO step in. The old one had been there for I think about 12 years. So she'd been there a while, and the new guy, I did have a chance to speak with him and was pretty impressed with him. He came from Henkel before this. I think the old CEO was very strong in engineering and product, but maybe this will bring a new perspective on like the business side of things. So that's my perspective on management, but I don't have a lot of
track record at Henkel was good.
I'm not sure. I haven't looked into it.
I think the best case you could make that when housing is cheap, this is a well-positioned company to play in housing. Now the question is, it's a pretty gray forecast at this point. I would suggest to you the way to figure out if housing is cheap, not the timing, but there's the Wells Fargo Housing Affordability Index out there.
and that's probably more accurate than whatever Freddie Mac or Fannie Mae is discussing. You don't know the timing, but you know when housing is cheap. And that's why, that's probably a better catalyst to say when that affordability is at a high level, that's when you buy it.
Okay. Yeah, I heard of that indicator,
Well,
so.
your whole thesis is based on whether this is gonna perform well in the next, till 2025 is based on housing. You can't get around that.
Yeah.
Whether housing performs well, there's no way to tell that. What you can tell is when housing is affordable to the average person, which is by definition, household income divided by mortgage rates.
Okay.
So.
Great, no more questions? Thank you.